Welcome back to Primary Source China Investment. This week we're on show I-7. And enough with the China equity. What about fixed income? Haven't we heard enough from all of the experts, the perpetually optimistic and the perpetually pessimistic alike? The pseudo-intellectual takes about touching stones to cross the river. Really, it's tiring. Markets are going to do their thing. And raising a fist in joy or anger won't change a thing. All right, I promise rant over, Pengguo, but what hasn't gotten enough coverage is China's fixed income market, where the real change is happening. That's the real bully on the block as well. Remember, the fixed income market is 155 trillion, whereas the equity market is like 85 trillion. So the fixed income market is much larger than the equity market. Also, cuts in interest rates do wonders for the net present value calculation of future cash flows for stocks, but gives anyone with a savings account a haircut. And that's the haircut that hurts. So recently, a lot has been changing. PBOC's made announcements. They cut deposit rates on 1, 2, 3, and 5-year time deposits twice this year. It also follows cuts on the mortgage rates to stimulate the economy. So a number of factors are happening. Deposit rates have come down, mortgage rates have come down, and what is the net effect of that? And we were looking at some calculations, but let's get into some of the rates because that's what people are getting returns on. So if you just want to put your deposit, right, you just put money in an account, non-guaranteed, just a savings account, you're going to get 10 basis points a year. Time deposits, what we might call CDs, 3 months, 6 months, 1 year. 1 year is 1.3%. 5 years, 1.6%. The 10-year government bond is 2.15% right now. The impetus is to get people to invest in equities, and maybe that already happened, right? We had a huge run-up, Pengguo. So is that transition, are we done now? Or what do you think? Because we'll get into the numbers a little bit more about the net effect of the economy, but I wanted to stop and get your thoughts right here.
Yeah, I think China fixed income is really a big market. So that is why in China financial system, bank always dominate entire financial market. So that's no doubt. So they can get the largest client base and they manipulate the channel. So all other financial institute, they have to rely on the bank channel or work with them. Interest rate definitely affect a lot of things. In my opinion, it's most of the people just not rely on the deposit to make the money. So that is really affect the mortgage rate. Fixed income market in China is very complicated. Generally, if you really want to get a risk-free interest rate, so that is not use the bank deposit rate. That normally use the security market, national debt, reverse repurchase. So that's kind of the rate. Most of the time, you can reach like the 2 or 3% every year. So that is almost the risk-free. I personally use that one as the risk-free rate rather than 10-year bond. Why not use a 10-year bond? Because bond market always get them up, down, up, down. So your principal could get loose during the market volatility. Or unless you really hold 10 years for this bond. Nobody do that in China. Fixed income common product, very popular. It's really for people make money. It came from bank. They provide they call wealth management product or wealth investment product. So that's 理财产品. So that's the thing is even complicated. Sometimes, most of the time is get the low risk, so people can get the principal and the interest. Obviously, if you are in the bad luck and you will get involved in the crash the real estate market, you probably can lose most of the principal from the bank wealth management product.
Those are great points because even repo rates are coming down, 理财产品 is coming, wealth management products are coming down. So all of this does have an effect on income. So if we do just take the deposit rate, and again, I totally agree, deposit rate is not what everybody depends on here. But bank deposits in China are 300 trillion renminbi. 300 trillion. That's double the size of the fixed income market. So it dwarfs everything. So deposits matter. And if you look at the net interest margin for banks, if you lower mortgage rates and you lower deposit rates, well, you're going to keep your net interest margin intact. But what happens with that is if you lower the mortgage rate, that's going to benefit some people, obviously everybody with a mortgage, but not everybody has a mortgage. So those people that don't have a mortgage are going to take a haircut on their income, whether they hold just a deposit or whether they hold repo rates or whether they hold wealth management products. So just do some quick math. And we did this a few weeks ago. A 50 basis point cut, which was announced, results in 150 billion renminbi less interest for only 50 million households. That's 3,000 renminbi per household per year. Compare that to what just happened on the deposit rate, which was a 20 basis point cut. That's 600 billion renminbi. In other words, cutting deposit rates hurts 8 times more than cutting mortgage rate helps. Almost everyone has a deposit account. In fact, most individuals have multiple deposit accounts. According to the PBOC, there are 14 billion savings accounts. Those are huge numbers. So when you decrease deposit rates, people who depend on fixed income, whatever income you're getting from those debt products, let's call them, you are taking a haircut as well. So that is going to absolutely affect consumers.
Yeah, that's definitely a great analysis to understand those relationship. And also, I think the risk cards, yeah, it's not just affect the fixed income market. It's more like the boom and the security or equity market. So that is push the money out of the bank to the stock market, which is increase the value in the stock market, which is in turn attract more monies flow into the equity market. So those kind of things is more like the I think people from the government perspective might think that's too much money in the bank right now.
Yeah. How do you get those consumers to either buy equities or consume? And the jury is still out. The jury is still
Yeah.
out. But I did want to cover two more things before we go, and I know we're running over time here. But the only renminbi denominated fixed income product in the U.S. is CBON, and that's doing quite well this year. It's up about 1.7%. If you look at the renminbi to U.S. dollar, it's basically round trip this year, so it's about where it started. Finally, I wanted to talk about something that we started this channel 3 years ago, and we've always talked about. Always buy some fixed income when you buy your China equity, because we have a 10-year comparison right now, and it's very simple. You look at 100% CSI 300 with ASHR, and you look at 60% CSI 300 ASHR and 40% CBON. Let's just take these two portfolios and compare them over 10 years. The 100% CSI 300 returned annualized return of about 90 basis points. The average annual return of the 60/40 was double that, more than double that. And also, it had about a third less volatility. Finally, Sharpe ratio of 0.09 for the CSI 300 and 0.10 for the 60/40 is telling you simply grab the risk-free rate, like Hongguo mentioned, for your China exposure. For comparison, the Sharpe ratio of VOO, which is the S&P 500, and the QQQ is 0.79 and 0.91 respectively. So we'll have all these charts up there, but it's good to keep this in perspective. And whatever your feeling is about the equity market in China today, you probably should grab a chunk of fixed income exposure. Final thoughts, Pengguo?
Yeah, I think definitely owning mixed with fixed income, you can get affordable volatility for you. Otherwise, purely equity market definitely will be under your expectations.
Affordable volatility. That, you know
That's
what?
right. Yeah.
When you launch a new product, it's going to be called affordable volatility. That's a great
Yeah,
tagline.
yeah.
All
Mm.
right, we're going to leave it there with show I7. Thanks for tuning in, and we'll see you next week.
Thank you.